Welcome to the Small Business Financial Summit on inflation and the economy, hosted by the Idea Collective and 620 WTMJ. Boy, it's fun to say those call letters again. 620 WTMJ. So much fun. We're sponsored by Bank 59, Quick Trip, and Crescendo Trade Risk. My name is Pat Miller. I'm the Idea Coach and the founder of the Idea Collective Small Business Incubator. Today's show is built by necessity and curiosity. Because if you're like me, you're noticing the price of groceries going up. Gas prices, not good. Volatility with interest rates and lending, delayed project and material times due to supply chain issues, and the housing market is just silly. And then if you're a small business owner trying to hire someone, the labor market seems so unsettled. So when conditions are this unusual, we have to turn our attention to our small businesses. Because if you're like me, a small business owner, you know you eat what you kill. And if we're going to enter into a short or long-term cycle that may affect our livelihood, we need to be aware. So when searching around for the information, I wanted to know what was going on so I could share it with our small business community. And I found competing stories. And tell me if this sounds familiar. One side was telling me, it's a blip. Don't worry about it. Everything's going to be cool by the midterms. I mean, in no time, right? And the other side was telling me, nope, it's doomsday. It's all over. Pack it up. Well, we don't have the luxury to guess. So we're here today. In this meeting, we're going to get an in-depth review of not just the economy, but the forces that are driving the inflation that we're seeing, the labor market, and the monetary policy. This information is literally up to the minute. Our guest this morning was updating the slides with news that broke today. It's unbiased and it's the most accurate information out there. I'm also fortunate to have a pro's pro on the show with us today. Vince Vitrano, he's my co-host. He's the morning anchor for 620 WTMJ. Good morning, Vince. Great to see you, pal. How have you been?
Good to be working with you in this capacity again, Pat. Pat and I did some radio work together as well in the past, and really, I want to first, I really sincerely, I want to applaud you for what you've built here and the company that you've built and the idea that you've put together. I think it's so necessary and it's super cool, and I appreciate being included in it. And to all of you who've chosen to join us, you small business owners and other people associated with this, I salute you. We know that small businesses are the lifeblood of our economy. And I'm just glad you're taking this time to be with us and hope that we can be of a help and service to you.
Well, I appreciate that, Vince. It is great to work with you again. And for folks that don't know, you were a television anchor forever, and now you have the most coveted seat in radio in the state. You are the morning anchor on Wisconsin's radio station, 620 WTMJ. How has the transition gone from being television anchor to radio anchor?
A lot of folks have mistakenly suggested that it must be nice that you don't have to wear a tie to work every day. I liked wearing a tie, number one. And number two, I wore a dark suit and a white shirt every single day for 25 years. Now I have to pick an outfit. And I have A, no interest in doing it, and B, I'm not real good at it. So other than that, it's great though, Pat.
You get to interview people all the time. So you've had newsmakers, governors, senators, and others on your show. Can you understand why those of us that are in your audience might be kind of frustrated about the information that people are putting out?
Yeah, and I think I'm hearing a couple of common themes. Obviously, you already touched on inflation, which affects all of us, so nobody likes that. But the frustration, you use the word frustration. When I hear from small business owners and people who are movers in this space, from vice president level of big companies on down to mom and pop organizations, the frustration is when you can't grow. You've got a good idea, you've got a good plan, you have a good product or a good service, and because of factors that are beyond your control, you can't grow. And that's frustrating because you did the hard part. You came up with all the hard stuff, and now because of things that you don't have a direct impact on, you can't be the company that you want to be. And so that's what I hope we can get some answers on today for all of you.
Yeah, let's get to those answers. We have a real luxury by having Vince here, a professional question asker and newscaster bona fide on the show today. Vince, thanks for joining us. Okay, let's bring in the star of the show, Dan North, senior economist, Allianz Trade, North America. Dan has been with Allianz Trade North America since 1996, using macroeconomic analysis to help manage risk portfolios for more than $150 billion in annual U.S. trade transactions. So this ain't no lemonade stand that Dan is used to talking about. He's appeared on CNBC, Fox Business News, and Bloomberg Radio and Television. He's also appeared on the Idea Collective Small Business Incubator. Impressive portfolio, you got to say. He's been quoted by Businessweek, the Financial Times, NBC, the BBC, the New York Times, and the Wall Street Journal. After having predicted the 2008-2009 recession and its implications accurately, he was ranked 4th on Bloomberg's list of the top 65 economic forecasters in 2010. Mr. North holds an MBA from Wharton School of Business. It's a real honor to have you here. Good morning, Dan. How are you, bud?
Very well. How about you, Pat?
I'm doing great. I am so fortunate. I just feel so fortunate that you're here to give us the answers that we're seeking. And as you're looking around, you just pull information from all different sectors and sources, right?
That's right. Quite a few different sources. And that's part of the problem with trying to understand everything that's in this environment is getting the right information and putting it together in a picture that makes sense. So hopefully I'll be able to do that for you today.
Yeah, Dan, just when we had a chance to catch up a little bit last week and talk about it, it just occurs to me that information from so many different sources must come at you like a fire hose. So how is it that you're able in your position to filter out what you need, what the good stuff is and what's not? Can you give us a little bit of an idea of how you process all this info?
That's kind of what I spend most of my day doing. There's a lot of data reports come out both from government and private sources virtually every day. There's a calendar of what's coming out today. So you have to keep on top of the major reports, read them, analyze what's there, often download your own numbers and crunch those to see what, in fact, the report is really saying. And then there are other news sources as well. I like CNBC. I like the Wall Street Journal. I think they're the most two straightforward publications. CNBC has nice, concise articles. The Wall Street Journal's in a little bit more detail. So it comes, and they're private surveys. We'll talk about a couple of those today as well. So there is a fire hose. You have to know what to look for, and that's why I've been doing it for a while and make sense of it all.
Well, we're excited to hear your presentation, Dan, on market conditions, and then we will get time at the end here for some Q&A from all of you, our guests. So Dan, I'll let you take it away.
Very good. Thank you so much. Let me bring up my screen here. And there we go. Okay, so I'm going to talk for about 35 minutes about the U.S. economy, and thank you everybody for joining this morning. I'm just there. And I'm probably going to ruin your day because, as I just mentioned, I look at lots of different data and you have to make sense of it and put a picture together. And right now the picture is, honestly, it's not great. So before I get into that too much, I want to give you just an idea of who we are and what we do. We're the world's largest provider of trade credit insurance. And basically the way it works is, if you're a business that sells to other businesses on open account, you run the risk that that other business you sold to, who's supposed to pay you back in 30 or 60 days, you run the risk that they go bankrupt in that time period and not be able to pay you back. We protect you against that. We protect you against non-payment. We have offices in 52 countries around the world. We have 5,500 employees. We've got a AA credit rating. We have 450 debt collectors around the world. We have a database of 80 million companies worldwide. And that's another feature of a lot of our clients use us for, because if you want to expand into a market you don't know about, or somebody to sell to somebody you don't know about, we probably do know about them. So we can help you from that aspect as too. We can safely expand your sales growth. We insure almost €1 trillion worldwide. And we indemnify 1,000 claims per week. We're a business insurance company. We're a discretionary purchase. So we have to add value to our clients. We have to pay claims. That's what our value is. Now, you can see that since we're insuring against non-payment, we have to have a big picture view of what's going on in the economy, and that's what we're going to talk about. It's the good, the bad, and the ugly. And the good is right now, there are some short-term growth prospects. And those growth prospects start with money. And money in the form of savings, that's the chart over there on the left. That is personal savings. And everything above that horizontal dotted line there, that's what we call excess savings, above and beyond what consumers would normally have. And it's about 18% above what they normally would have. And that's been fuel for inflation. It's this $5 trillion of fiscal stimulus that came into the economy, providing the ability to spend. And consumers also have another source for the ability to spend, is their debt level. Debt service level is quite low. Households are managing their debt very well, which means they could take more debt on if they needed to. And consumers at the moment, for the moment, have a high degree, relatively high degree of confidence. So they have the ability and the willingness to spend. And that's what they've been doing. Consumption, personal consumption, is 70% of the economy. So they have that willingness and ability to spend, and this personal consumption expenditures is up 6.3% annually since pre-COVID, compared to a pre-COVID number of about 3.9% annually. So that's why we've had a pretty robust recovery, and you can see it on the right there as well. That's retail sales. In the previous recession, the Great Recession, it took retail sales 41 months to recover. This time around, it was 4 months, and they're growing at a rate of 11% annually versus a pre-pandemic average of 4.3%. So spending has really been driving the economy. We also have plenty of work in the pipeline. Now, that chart on the left, the ISM Services survey. ISM stands for the Institute of Supply Management. It's a carefully watched survey. It goes back almost to World War II. And this is a survey to service managers. It's the supply managers have to kind of balance what to buy compared to what they think they're going to sell. And the way these ISM charts work is 50 is sort of the break-even line. Above 50 is usually something good. Below 50 is not great. Well, in this case, we're looking, for instance, at the blue line is backlog of orders. Since it's above 50, it means that backlogs are still increasing. New orders, the tan line, above 50, new orders are still increasing. So we have new and back orders in the pipeline, providing lots of economic activity and employment going forward. On the right hand is the manufacturing side of the economy. New orders for durable good, up strongly, as you can see. Again, work in the pipeline, providing employment and activity going forward. Labor market looks really pretty good, remarkably good. The chart on the left shows the tan columns of jobs created, and you can see, it's pretty massive here over on the right. And that blue line is that unemployment rate down here near a 50-year low. It's 3.6%, 3.5% is the 50-year low. So the employment labor market's good. And there are a couple of other indicators over there on the right. These are jobless claims. So the blue line is initial claims. These are the number of people that come into the unemployment office and say, hey, I lost my job, I got fired, or the business closed, or whatever. I need my unemployment benefits. That blue line you see there, that horizontal dotted line, that's the level we have now. This goes back 50 years. You can see it's almost never been that low. The brown line is continuing claims, the number of people who are still on the unemployment rolls. That, as you can see, goes back towards 50 years and has rarely been that low. So we got some good signs in the labor market. We also, stuff like this, the jobs report, number of jobs grown, ISM surveys, they usually come out monthly and they come out with a monthly lag. But we also have what we call high frequency indicators, which come out weekly or even daily. And some of those are looking pretty good. So for instance, the left there is a JP Morgan credit card tracker. and it's up 6.3% above the 2019 level. That's that blue line. So that's pretty good. Over on the right is TSA throughput. So 2019, the dark blue line was normal times, and then you see the tan line is 2020, fell down to virtually, not quite zero. 2021, the green line, better, but not towards 2019. And then the lighter blue lines, 2022, getting closer to pre-pandemic levels, even though it feels a lot worse than that if anybody's traveled recently. So these indicators are pretty good. And there are a couple other ones here too. The one on the left is open table seatings. So the blue line is the 2020 change versus 2019. Dining just went to zero basically when the economy was shut down. Last year, the tan line got up towards pre-pandemic levels, but then fell off. The green line is this year, 2022, around pre-pandemic levels, looking pretty good. And finally, on the right, that green line is hotel occupancy, again, coming up back towards pre-pandemic levels. But you might see up here in the top, I've said on all four of them, they look good, they don't look great. They're positive. They look good, but they're not terrific. Now, so that's the good thing. We've got money to spend, we've got consumer confidence, people are spending, we've got work in the pipeline, high frequency indicators look pretty good. So that's all good. But the economy is facing many, many big risks. And the biggest risks are actually coming from government policies that were implemented in 2020. Now, the government has two tools to help manage the economy. One is fiscal policy, which is taxes and spending. That's run by the administration and Congress. And then there's monetary policy, which is run by the Federal Reserve, which helps influence interest rates. Now, when the COVID came along, we had the national emergency shut down the economy, basically. Congress pumped right away $2 trillion worth of stimulus into the economy. And then another $1 trillion at the end of the year. And then another $2 trillion in the American Rescue Plan in earlier 2021. So it was $5 trillion of money that was pumped into the economy by fiscal stimulus. Well, that adds to the debt level. Now, that brings us up to a debt level of something like, I don't know, $23 trillion of debt we owe. I don't know how much that is. It's very hard to understand how much that is. But if we can compare it to the size of the economy, which is GDP, gross domestic product, then you get a measure that's more like the size of your mortgage compared to your income. And that's what the chart is over on the left. This is the debt to GDP ratio. And it topped out here World War II at just over 100% to finance the war. Then in more modern era, you can see that dotted white line, that was around 30 to 35%. And in the Great Recession, it went up to 75%. And then we added another $5 trillion, jacking up another 22% to 100% of debt to GDP ratio. And we're going to clearly exceed the World War II height. Now, the trouble with that much debt is it is going to cut future growth in half. More debt, slower growth. But more importantly for now, it's too much easy money pumped into the economy, and it's a cause of inflation. What's even worse is the chart on the right. This is monetary policy run by the Federal Reserve. Now, the Fed has two tools to help manage the economy. And one is that blue line, the Fed funds rate. You always hear about the Federal Reserve is raising interest rates. Well, the Fed actually only controls one interest rate. It's the overnight Fed funds rate. It does influence all the other interest rates, but it's just controlled one by the Fed. And that's that blue line. And you can see going back in history, it was 10, 15%. And then we came along to the financial crisis, the Great Recession, it was set down to zero. Never been done before. Emergency conditions. Held there for quite a while. Came back up, and then when COVID came along, set back to zero. Now, this was the right thing to do to stimulate the economy, put the interest rates down towards zero. That's one tool. The other tool that the Fed uses is that brown area, which we call the balance sheet. Just think the balance sheet as the amount of money that the Fed is making available to the financial system to keep credit flowing all the way down to businesses and individuals. You can see actually that tan line, that tan area was never really used before as a tool until we reached the Great Recession. And then we pumped up the balance sheet. It's virtual money printing or quantitative easing. And then we started to pare it back. But when COVID came along, the Fed exploded the balance sheet again. Now, this again was a right thing to do at the time. Okay, this was the second quarter of 2020. Third quarter comes along, the economy makes this gigantic recovery. If you're the Federal Reserve, you might say, that's great, let's wait one more quarter to make sure everything is okay. Well, they waited one more quarter, two more, three more, and four more, five more, and six more quarters. They kept this policy of 0% rates and enormous money printing in place, arguably for over a year too long. It's incredibly loose policy of too much easy money for too long, and it is the classic formula for inflation and for the tears we're experiencing now. This, I believe, to be one of the biggest sources of inflation. If you wanted to start an inflationary fire, that's how you do it. That's how it's always been done. So let's look at some measures of inflation. So on the upper left is the one that's most commonly looked at. It's the Consumer Price Index. You can see it's at 8.6% now. It's the highest in 40 years. 40 years, and look how rapidly it went up. And it's not just food and energy. You strip those out, you get a thing that's called the Core Consumer Price Index, and that's at over 6%. And that's the highest in close to 40 years as well. Column over here, the second column, producer prices, also wholesale prices, up towards dramatic higher records. The previous record was 4.5%. It's up at 10.8% now. Same thing with the core producer price indexes. Another measure here in the third column of consumer prices. Here's this core PCE deflator. This is the Fed's favorite gauge of inflation. You can see that dotted line there. That's the target at 2%. The target is 2%. Now we're up around 5%. So that's one measure of how far behind the Federal Reserve is. And I'll talk about that some more. There's more inflation showing up in that ISM survey, both in services and manufacturing. And then down here in the lower right, we have inflation in housing. Since May 20, housing has gone up 30%. Hourly wages have only gone up 7%. So that raises a question of sustainability. There's inflation in housing for sure. There's also inflation for the first time in decades in wages. You see, for decades, the US has been exposed to, or really US consumers have had the benefit of getting goods and services from countries like Mexico and China, where wages were very, very low. And that's what's held wages down here for so long and held inflation down here for so long. Not anymore. Not anymore. Low wages have been a missing key, and they are going to contribute to inflation going forward. And the trouble with wages are they're sticky. They don't come back down very easily. Now, if you give someone a raise, you really can't take it back. That would be a poor business practice, and you wouldn't be in business long if you did that. In fact, on a year-over-year basis, wages basically have never come down. And now we have the highest wage growth in almost 40 years. So nominally, the actual number is 5.1% growth year over year. The pre-pandemic average was 2.5%. That's great. Workers are getting a raise. It is. But after you strip out that 8.6% inflation, the real wage increase, that brown line, is negative 3.5%. Wage earners are losing ground. They're not even running in place. Yeah, they got a nice boost, but inflation is just ravaging that boost. Now that blue line there is for all workers. It only goes back till 2010 or so. We have a much longer series for what we call production and non-supervisory employees, the chart in the upper right. That goes way back, and it does show, in fact, we were recently again at a 40-year high in inflation. So we have inflation in wages in the economy, and there is more to come. How do we know this? Well, there's this survey from the National Federation of Independent Businesses, Small and Medium Enterprises. And the way this chart works is it's the net percentage of respondents, the tan line, the net percentage of respondents who raised compensation in the last 3 months, second highest ever. Here was the highest right there, very close. The blue line is those planning to give compensation raises. That was at a record here. It's come down, but historically it's still very high. So employers know they're going to have to pay higher wages. And as a result, they're going to have to increase their costs, increase their prices as well. So here's the same survey. The tan line is the percentage of respondents reporting record high selling prices at a record high. And those expecting higher prices also in the top 1% ever of all observations. So we have wages that we already have there. There's more to come. And as a result, you can see on the lower right chart, we have inflation as a result. Well, why do we have this pressure in wages? Well, we have a labor shortage. Now, the chart on the left, that blue line is the number of job openings we have in this country, 11.3 million job openings. Employers are desperate for labor, as probably you all know. The brown columns are the number of hirings, 6.5 million job hirings. So there's this enormous gap here that we had never really seen before pre-pandemic times. It's a giant gap. So the employers with all these jobs can't get people to fill them. Do notice one thing though, the blue line is turned down. So job openings are starting to shrink and job hirings are down for the last 3 months. So I'm getting a feeling that employers are starting to say, maybe we're not real interested in hiring that many people. And as a result, not that many people are getting hired. In fact, we're starting to hear talk of hiring freezes. And in the high-tech industries, they're letting people go as well. Nonetheless, so this is where the labor shortage comes from. And in the chart in the middle is quits, people quitting their job. 4.3 million people quit their job last month. So the chart on the right, the text is why the labor shortage and the quits. Well, a lot of people are just going to a new job. Some people are actually, a lot of people are starting their own business. They've been working from home. Now they can see they can work on the internet and, sell goods off the internet, that sort of thing. There still is fear of COVID in the workplace. Retirement was a big one. Some studies estimate that 2 to 3 million people retired out early. We're still missing, it's now down to about 1 million jobs, but 2 to 3 million people retired out early. The national emergency comes, your business is shut down, your job is shut down temporarily, and then it gets shut down permanently. Thinking about retiring and you're not, am I going to be able to get a new job at this age? And, that's COVID thing I'm not so sure about. I'll just retire out. And that's where a large part of it is missing. So we have a labor shortage, which is increasing wages, which is feeding straight into inflation. There's another feature feeding into inflation, which is the supply chain. A lot of people are saying, oh, the supply chain's easing up. Well, that may be true, might be getting better, but it's not completely unclogged. Here's a chart I've gotten from the Southern California Marine Exchange. It's about container traffic waiting to unload at Long Beach in LA. It's a slightly messy chart, but walk through it here with me. This line in the middle, this grayish line, is the number of ships, container ships, backed off of LA and Long Beach, and it peaked at a record high of 109 on the 9th of January. Well, they have worked that backload down to 25 ships, 25 ships waiting to get into LA and Long Beach. That's great. 109 down to 25 is good. But if we go back in history and follow that gray line all the way over to the left, the usual number of ships waiting at LA is 0. 0. We're at 25. So the argument about the supply chain easing, yeah, it might be easing, but it's got a long way to go. Now, that ISM survey I've referenced a couple of times, got lots of numbers, but it's got great commentary from the participants, and I won't read you every one of them. But they're seeing a lot of the same thing. Change semiconductors hasn't softened, passing along costs, Shanghai shut down, production, supply chain, lead times, supply chain issues, going to North American shipping, price increases, supply chain, so forth and so on. Supply chain is still one of the biggest issues for everybody in business. And that is feeding into inflation. Okay, let's talk about who's supposed to take care of inflation. The Federal Reserve is supposed to take care of inflation. They're charged with balancing a too hot versus too cold economy. If you get too much inflation and too low unemployment, that's too hot an economy and you're supposed to raise interest rates. That's what the Fed is supposed to do. When it sees high inflation coming, it raises interest rates to slow the economy to cool inflation. This time, it waited far too long. Unemployment got far too low. Inflation got far too high. Now the Fed is going to have to move far too much, far too rapidly. They are desperately behind the curve. Inflation is at the highest in 40 years. Neither the labor shortage nor the supply chain problems are going to disappear anytime soon. But most importantly, the Fed has already made 3 big mistakes. That first one we talked about was too much easy money for too long. Then they held on to this narrative in 2021, all through the year of saying, that inflation in that report, don't worry about it. It's just transitory. Next report comes along, higher inflation. Don't worry, it's okay. It's just transitory. Finally, at the end of 2021, they said, yeah, I guess it's not transitory. That's the December of 2021. You're acknowledging that the inflation is not transitory and you're going to have to do something about it. Well, they didn't do anything about it for 4 more months. In fact, they kept throwing gasoline on the fire. They kept flooding the balance sheet with even more liquidity, and it was 4 months before they raised interest rates for the first time. That's bad mismanagement, I think. As a result, they're desperately behind the curve, and it's important to know that changes in monetary policy take 3 to 5 quarters to work through the economy. So they've hiked at 1.5% so far, and they're going to raise the Fed funds rate another 75 basis points in July. That's great. It's the right thing to do, but they're not going to completely kick in towards the end of the year. The Fed usually waits too long and goes too far. And again, remember, when a central bank raises rates to quell inflation, it's deliberately trying to slow the economy, and it works. That's the risk we're looking at. There's another way of looking at how far behind the Fed is, and that's this chart over on the right. And qualitatively works like this. Every dot is the beginning of a hiking cycle. And the way this chart works is the further out this way the Fed starts, the more ahead of unemployment it is. And the further this way the Fed starts, the further in front of inflation it is. So you want to start down in this corner, like in November of 2015. You're ahead of inflation, you're ahead of unemployment. This is the last place you want to be, and that's where we started now, far behind unemployment and inflation, and it's too late there. So the Fed has finally recognized that they're very far behind, and now they're on the warpath, and now they're accelerating to 75 basis point hikes, which are very rare. And they did that, last time, and they're going to do it next month as well. I won't go into all the detail here, but it really, a number of things came together at once to push them over the edge. And the feeling is that by the end of the year, that Fed funds rate is going to be over 3.5%. That's very high, very rapidly. And that policy is probably going to push, let me rephrase that, may push the economy into recession. Now, that shows up in a couple of different measures here. My timer has just gone off, so I got to make sure I am on time. Here's one measure of the economy. It's my favorite. It's a really strong leading indicator. It's called the Treasury yield curve. And the yield curve is just that blue line. It's the difference between short-term and long-term interest rates. It's the difference between the 10-year and 2-year rate. So for instance, let's say it's plotted over here at 300 basis points. That might be where you have the 10-year at 4% and the 2-year at 1%. And that gap is that 300 basis points. And it's usually that way. You usually have long-term interest rates higher than short-term rates until you get into these conditions like now, when the Fed starts jacking up short-term rates to the point they become higher than long-term rates. And that blue line goes negative. Every time the blue line goes negative, the yield curve inverts. It's followed by a recession. Happened back here in the early 80s. That blue line went negative, there's a recession in there. Early 80s, the blue line went negative again, a recession. Here, gotta move my window here. Every time it goes negative, there's a recession. And yes, we were getting close to a recession going into 2020. I can't claim credit for COVID, but we were headed towards a recession. Now look where the blue line is now. It's still positive. It's still positive, and that's a good thing. Now, this data on the left is quarterly data, and I put it that way so you could see how it works. The data on the right is on a daily basis. This is the same blue line, and it has gone negative. It has inverted now for, I think it's 5 or 6 days. That's not a strong enough signal, but it's going the wrong way for sure. Very strong indicator going the wrong way. And it's not just the yield curve that is a good signal for a recession. Recessions usually come in a confluence of events. Here's one called the Consumer Confidence Survey. It's a 2-part phone survey. They ask, how do you feel about things now? People are saying, okay. How do you feel about things in the future? And the answer is, oh, no, that looks really bad. And when those two answers diverge sharply, that blue line goes negative. People are much more concerned about the future. It's associated with the recession. All those gray columns there, those are all recessions. You can see when that blue line goes negative, recession here, and look where we are now. So when consumers are concerned about the future, they're usually right. And recessions are also associated with spikes in oil prices, often caused by a war. It's not really the case here, but every time there's been a spike in oil prices, not just about every time, it's associated with a recession. And another thing is a burst asset bubble. In 2001, there was the tech bubble that burst. 2008 and 2009, the housing market bubble burst. And that might be the same thing again this time. We have inflation, rapid inflation in housing prices. So it's not just one thing, they're coming together. Now let's move on to the last part, the ugly, which is the war and its effect. The war has some big problems because Russia is the world's largest fertilizer exporter, second largest oil producer, exporter. Ukraine supplies 90% of the US's neon, which is used to manufacture chips. Neon prices are up by a factor of 10 since the invasion. And of course, Ukraine and Russia supply a large part of the world's grain. Now, for the US, when we talk about the oil supply, it's not really a matter of oil supply for us. It's more worry about oil prices. We used to have Russia imports were only about 3.4% of our consumption. That's down to 0 now. Now there's this plan to release oil from the strategic petroleum reserve, and it's a pretty questionable one. The SPR was created after the 1973 Arab oil embargo and was meant to mitigate a supply crisis, not a price crisis. We really did have gasoline rationing in 1973 and 1979. You can see in these pictures, people waiting in line, different indicators of whether you can buy gas or not. This poor guy pushing his lawnmower, no gas for sale. So the current plan releases only 5% of consumption every day, would draw the SPR down to the lowest level in 38 years. Now, in a time of global uncertainty, now is when you want a bigger reserve, not a smaller one. So it's not a great plan, and its price effect on prices is pretty questionable anyway, because it's going to have to be bought back at some point. Let's just look at oil prices here for a minute. There's a lot of information on this chart, but basically the point is, when oil and gasoline prices rise this fast, that's when they're harmful to the economy. Now, this is not Putin's price hike. It's not Putin's price hike. Let's look at price increases on crude oil since the invasion. Yeah, they're up 36%. Year to date, they're up 48%. But since May of 20, they're up 363%. That's where you've gotten the big inflation in oil prices. And by the way, July's number at $106 a barrel is less than the record. And on inflation adjusted terms, it's way less than the record. On the right is gasoline, same sort of story. Since the invasion, up 39%, year to date, 39%, same thing. But since May of 20, up 151%. It's not Putin's price hike. And again, our nominal $4.80 a gallon in July was above the record nominal, but is less than in today's terms, today's dollars. Now, a big problem is we have problems with, prices of oil and gasoline. Gasoline prices are tough. Europe has a much different and worse situation. Europe gets 41% of its natural gas imports from Russia, 41%. You can see all these pipelines coming from Russia, sort of this dead hand crawling into Europe. And you see this one coming into Germany, that's the Nord Stream pipeline. And just yesterday, that was just shut down to zero. So Russia has stopped sending gas to Germany just yesterday. Now they had an excuse. They had, there was a problem with part here, and then this is annual regular maintenance, so to speak. But Germany's very concerned that that's going to stay at zero going forward. That's a big problem for the biggest economy in Europe. How are you going to replace this natural gas? Well, there are different ways of doing it in a quick turnaround. It's less than 1 week. In the longer plan, this is the longer plan, more LNG exports, so forth, other things. But it's very optimistic. What's going to have to happen is they're going to have to bring coal back online. Germany is already restarting 10 coal-fired plants. That's a big blow to their green energy devotion. Other commodities, wheat and corn, you can see, since the invasion, they're actually very low increases, but since 5/20, since the reopening of the economy, urea, another agricultural product used to make fertilizer, up big time. And here, natural gas and coal, well, yeah, there has been a dramatic increase in those commodities, both since the invasion and since May of 20. Okay, let me wrap up here. The risks to the economy are significant. Sorry, there's raging inflation, rising oil and gas prices, rising wages, labor shortage, supply clog chain. Consumers are worried about the future. They're running behind with inflation. And now the Fed just have to go on a very aggressive path of raising rates, which could well raise the possibility of a recession in 2023. That chart I showed you with the yield curve, I forgot to point out one thing. The yield curve usually gives you 3 to 5 quarters of warning. In other words, when the yield curve goes negative, it gives you about 3 to 5 quarters warning ahead of time that a recession's coming. So we don't see it this year by any means. But I do want to end on a positive note. There is some positive things going on in the economy. We do have fuel from consumption, for consumption from savings and low debt levels. We have high consumer confidence, work in the pipeline, those high frequency indicators look okay, and a very strong labor market. So right now, it's okay, but I'm pretty concerned about 2023. Okay, and one last thing, I am going to make this presentation available to you, and here's some things to look for. When you get major data releases, you just read the news stories. They're more important, useful than the reports. Here's some important ones now: the Fed meetings, employment report on the first Friday of every month. Here's a link to the yield curve you can just go to. And then there are inflation reports like tomorrow. CNBC.com's got really good short articles, as I mentioned, and the Wall Street Journal is very good as well. Okay, so I know we're coming up on time there, but that's the presentation. And I really thank you very much for your attention. And now let's go to some Q&A, please.
Dan, that was unbelievable. The update was spectacular. You answered a ton of our questions. We had an entire page full of questions from the folks in the audience. You've touched on many of them. I know Vince and John have a few. And if you're watching and you have questions you really want to get answered, put them in the chat. One thing that's important to note, Dan is paying attention to all of these market forces, but he can't tell us what to do. He can tell us what he sees, but he's not going to recommend what we should be doing. So it's just something to keep in mind. If you ask a question and I don't use it, that might be why. One of the questions I want to ask about is, independent of the official designation of a recession, if employees are falling behind and prices are going up, people are being harmed, right?
Absolutely. And the the definition of a recession, it's really a label. And it used to be 2 consecutive quarters of negative GDP growth. It's not that anymore. It's more vague. It's a broad downturn throughout the economy for an extended period, and has to be, broad and deep and showing up in a number of indicators. It's a label. It's a label that's imposed after the fact by this organization called the National Bureau of Economic Research. So the NBER tells us 3 months after it's over that, oh, yeah, we were in a recession back then. Who cares? Now, it's useful for economists like me and sort of studying historical patterns. But you're right, when people are losing their ability, their purchasing power, they're falling behind, that is real economic harm. 70% of the economy is driven by the consumer. So when the consumer is having to peel back, is having to pull their horns in on consumption, that hurts the economy, and it's obviously a big human cost, particularly for lower income families.
Good stuff. Okay, thank you for that. I know Vince Vitrano from 620 WTMJ has got a bunch of questions. So Vince, take it away.
Yeah, Dan, let me start with this as well, because I think you've well documented, what our governmental policies have done to contribute to, if not entirely cause, the situation that we're in. But I speak with a lot of politicians as well in my role, and they are rewarded by the electorate for handing out the free money that you point out is causing all the damage. So I wonder how things will turn. And we've got a couple here from Southeast Wisconsin. Former Speaker of the House, Paul Ryan, used to always talk about Social Security and where we were going with that. And nobody wanted to hear it because it wasn't sexy and it's not easy to campaign on. His successor now in that office in the 1st Congressional, Brian Stile, Congressman, talks about what a terrible idea it is, in his opinion, to eliminate college debt that people have accumulated. But nobody wants to hear it. That's not sexy to campaign on. So I wonder how we emerge from this.
Wow. Well, there are a couple of problems. Nobody does want to talk about it. Republicans and Democrats alike do like to spend money. And I think the thinking on the subject now is, now's not a good time to cut back on expenditures. The big problem we have with so much debt in this country is the big 3 entitlement programs of Social Security, Medicare and Medicaid, and welfare. That's 2/3 of the budget. they are untouchable. They're called mandatory spending, and politically, they're the third rail. Start talking about those, you're dead. So, people are concerned about, say, why are we sending all this money overseas, all this foreign aid? Well, if you had the budget in a pie chart, 2/3 of it is those mandatory entitlement programs, you couldn't see the slice of pie that is foreign spending, support for foreign countries. You couldn't see it. It's those big three ones that make up all the difference. And they have the fatal demographic. The fatal demographic, which is we have more older people leaving the workforce that need to be supported by younger people. And these older people are staying alive longer than we thought they would. And because they're staying alive longer than we thought they would, they're sicker too. So those programs are being drained more rapidly than we ever thought they would be. Now, that sounds really bad. Two things to consider. We can sustain a very high debt load indefinitely, given that we have the world's reserve currency, we still have the world's biggest economy. Japan has twice the debt level that we do. You can sustain high debt levels indefinitely. It just means slower growth. That's one thing. There can be a solution to these problems. One is to embrace skilled legal immigration, because skilled legal immigrants bring in high value added. They create more jobs than native born Americans. They can create jobs that start paying into these programs more rapidly. And that would ease up the problem. But you're right, it's the third rail. It's not a topic anybody wants to talk about right now.
Dan, let me put this out there too, because it's a topic that came up in the conversation with some small business owners the other day. The idea of, in our current conditions, even if you have a cash reserve, but you want to grow your business, is this a good time for a small business to take on debt, or is it exactly the opposite? And I hear arguments on both sides. I wonder if you have thoughts on that.
Right. Well, in inflationary periods, it's actually great to be a debtor. And think about it this way. Think about it in terms of your house. So you have to pay a fixed amount every month for your mortgage, a fixed amount. But because of inflation, the price of your house is going up. So you're building up equity very rapidly. And the same principles apply in other forms of debt. It's good to be a debtor in inflationary periods. Now, you maybe have missed out with the interest rates going up so rapidly. The other way to look at this is anytime you take on debt, you're going to have to pay it back. You're going to have to pay it back. So you have to kind of balance those two things. If you're a big corporation, you have access to lots of money in capital markets, you can afford to become more of a debtor. If you're a small business, things could get pretty rough coming up here. Maybe you want to be pretty careful about taking on more debt. I hate to sound like an economist, more debt to grow, but then you have to pay it back, so maybe you shouldn't. Those are the trade-offs. That's what we're facing.
And that's the type of decision that we need to make, Dan, is the risk when you don't have the financial backing of shareholders or large cash reserves. Taking on that extra debt puts us in a precarious position. If there are questions that should go in the chat, get them in there now because we're almost out of time. I want to bring in John Cornell from Crescendo Trade Risk, one of our sponsors today. First of all, John, thank you for helping to make this show happen and bringing Dan to us. But I'm sure you've got some questions. Go ahead.
Yeah, I've actually got a couple. So, Dan, on slide 12, you showed 8 charts, 8 different indicators of inflation sliding above the 2% target. There's so much history showing that roadmap, the tools we have to control inflation. So it was jumping out at me with that much information. The Fed did nothing. What was their explanation? I've looked for it and I saw 7 different directions of their explanation. I never really got one that made any sense.
Right. Well, part of the problem is this. The way the Fed and other central banks used to operate was, we see inflation coming, we're going to raise interest rates to keep it cooled down. The Fed and other central banks likes to have a little bit of inflation, because if you don't have inflation, you get to zero inflation, then that maybe goes to negative inflation. and then monetary policy is helpless. And then you go into a depression, perhaps. So a little inflation is a good thing. And they couldn't get to that 2%. They couldn't hold on to that 2%. So they changed to a new way of doing it called inflation targeting. And what they said was, when we see inflation coming, we're going to wait till it gets to 2%. We're going to wait when it gets over 2%. We're going to wait a while because we want that inflation. Well, that's what they did. When you make a change in policy, you can't just say, a year later, yeah, policy doesn't work, we're going to go back to the other one. That just totally destroys any credibility that the Federal Reserve would have. So they were using a new framework, and it put them way behind. And then again, all that easy money they should have taken away, all that thinking that inflation was transitory, and then not doing anything about it. That's why I have not much faith in this Federal Reserve.
So thank you for that. That gives me at least an understanding of why they did it, but kind of the thought process behind it. So my second question is, we all know as business owners, momentum is powerful. Once you start going a certain direction, it makes it tough to stop. Well, we've got consumer confidence, although right now looks okay because we've got some savings and some money built up, but you showed a couple indicators where it's starting to slide. Then we've got supply chain issues. We've got political headwinds with the midterms and all the negative advertising that poisons our head and makes us even more or less confident. Assassinations in Japan, the war in Ukraine, all this uncertainty. Doesn't the uncertainty kind of become a self-fulfilling prophecy, and that everyone stops spending because they're afraid, and we end up in a worse place than if we maybe spent a little?
Well, as I'd said a couple of times, consumer spending drives 70% of all economic activity. So yeah, when we stop spending so much, then the whole economy turns down and unemployment starts going up and so forth. That's human nature. I'm not sure I would say it's a self-fulfilling prophecy. In the case of inflation, it is. If you expect inflation, more inflation will come. But if there's an event in Ukraine or an assassination somewhere, how are you supposed to react to that? You have to react to it. It's not really a self-fulfilling prophecy. That would be going backwards in time. So there can be a decline in consumer confidence, which could affect us. Consumer confidence is interesting because consumers will often say one thing and do another. So they may say, oh, we're not very confident, but may continue to keep spending. And it's also interesting if you look historically at the stock market, looking at about 30 big events from World War II on, stock market usually shakes it off in a couple of months. The world goes on. So I think that's probably what we're going to see, as bad as it feels at the moment.
Dan, we're up against time, but we have some great questions from the audience. Can we play lightning round just a little bit? Because we've got some good stuff I want to address.
Sure, I'll make some short answers.
Wonderful. Michael Rampolo's got a question about the job market. In similar past job markets, what strategies have been successful for employers who need to add workforce, but they're struggling to recruit and retain? Have you seen any patterns or strategies that come to mind?
Well, people are trying everything right now. Increased wages, increased benefits, signing bonuses. I've got a landscaper that's giving 401ks and profit sharing, and none of it seems to be working. So they're throwing the kitchen sink, and none of it seems to be working. So I don't know what else they can do at this point.
Let's talk about generational issues. Brad Herta asks, some economists have said the 2020s will be good and 2030s could be tough based on the aging of the U.S. population. Any input on that?
Well, I think you're looking at the demographics of the generational shift of maybe a generation that is less interested in working hard, for instance, and producing more and growing the economy more. So it's not a bad presumption. Baby boomers are going to keep retiring from the workforce at the rate of 10,000 every day.
Wow.
So it's not a bad presumption.
And this one, I can't believe that we went this far and really haven't addressed it. Mary Weeder asked, what about stock market and the stock market correction? Are we anticipating, I know you can't predict, but are these the forces that would cause a stock market correction, or will it stay immune?
Well, just this will not be a lightning, but I'll give it as quick as I can. The stock market and the economy are not directly tied, believe it or not. The stock market looks into the future, what interest rates will be, what earnings will be, not what's happening now. So there can be a disconnect. And concerning stock prices, I was in investment research for 3 years. You can't predict where the stock market's going to go. So the only strategy is to buy and hold, buy different assets and buy and hold. And I'll tell you why, because I've seen this study twice over a 20-year period. 20-year period, the biggest movements in the stock market come in just a handful of days. So over 20 years, if you miss the 10 best days, your return is cut in half over 20 years because you missed that compounding from the biggest days. So you want to try and figure out when to get in and out of the market, you're going to lose.
Last question I have, and again, I don't know if you can say this, but I'm just looking for your ability to apply context to all of this. How could we look at a best case and a worst case of where we're going? I mean, how bad could this be? How good could this be? And I know that that's a big question to ask you, but if I was going to ask anybody, you're the guy. Can you answer that at all?
No.
Okay. That's fair. That's fair. It's completely fair because we don't know the answer either. But when we see all this information, that's why we wanted to have the conversation today, because now we have the information we need to try and make the decisions that we have to make to protect our family and protect our business.
I'll just try and not be too smart about it, but you come with scenarios. The Fed might be able to engineer this soft landing where they managed it perfectly. I doubt that's going to happen. So I think that recessionary risks are rising. I don't know how bad the recession could be. So it's very hard to say. And I have leading indicators that tell me what I think is actually going to happen. But there are things that could mitigate that could change those circumstances in the future. And the future is unknowable by definition. I can just make an analysis off of what I have.
Well, the analysis was fantastic. Dan, thank you so much for the time today to inform our small business community. Vince Vitrano from 620 WTMJ, thank you so much for coming on and helping us today. Big thanks to our sponsors, Bank 59, Quick Trip, Crescendo Trade Risk, and the Idea Collective Small Business Incubator. We are going to ask for your feedback on the event. We're dropping into the chat right now. What did you think of this event? Should we start a GoFundMe so we can bribe Dan to come back and do this again? Because I found this informative. Like, what could we do different? What kind of conversations could we have? How else can we keep you informed and up to date? Please fill out the survey that we just dropped into the chat. And also, we will send you a recording of this entire presentation to your email if you registered for the event. And for those of you in the Idea Collective Small Business Incubator, we'll make it available in the vault as well. I'm Pat Miller, the Idea Coach, founder of the Idea Collective Small Business Incubator. Thank you so much for coming to this important meeting, and we'll see you next time.